In this lecture, I will go over popular terms and concepts that are used in regards to stocks and the stock market. This is a more difficult lecture to go straight through, so I recommend using it as a reference point to spot check if you encounter a specific investing term you don't understand. Bulls and bears refer to if an investor feels confident or pessimistic about a stock or the stock market. Bulls are optimistic. They are courageous and charge ahead buying shares, while bears are pessimistic. They would rather hibernate and they want to sell their shares. Bid and ask are due to the auction format of the stock market. These refer to the prices you can buy and sell at. A bid is the highest price a buyer will pay for a share. An ask is the lowest price a seller will sell a share at. These bid and ask prices help to form what you see as stock prices. The term capital refers to financial resources available for use. It can be used as a synonym for assets. A basis point is a unit that is equal to 1/100th of 1%. If you are 100 inches tall, 1/100th of an inch is a basis point of your height. Basis points are tiny units of measurement, but are important for tracking bond yields since they tend to change less than 1% on a given trading day. Liquidity is the ability to turn an asset into cash and use that cash. This helps to measure how easy it is for a company to pay off its obligations, and it can become very important if a firm suddenly experiences an earnings loss. The balance sheet is a financial statement. It summarizes the company's assets, liabilities, and shareholders' equity at a specific point in time. This helps to illustrate what a company owns, what a company owes, and how much money the investors have invested in the business. The term assets refers to the possessions that a company has, present or future economic value to the owner. It can be cash, inventories, factories, prepaid insurance. While liabilities are the other side of that coin, they are actual or potential financial obligations. These usually take the forms of debt. The third category in the balance sheet is stockholders' equity. This is referred to as the book value of the company. It refers to the capital received from investors in exchange for stock, otherwise known as paid-in capital. Stockholders' equity is equal to assets minus liabilities. Accounts receivable is found on the balance sheet. It's the money owed by customers to the business. For instance, when you buy an item on credit, you enter onto that company's accounts receivable balance. The term depreciation is how much of an asset's value has been used. For example, if you buy a computer that will last 5 years, you depreciate or use 20% of its value each year. Amortization is similar to depreciation, except that it refers to the use of intangible assets. The value of a patent is a standard example of an asset being amortized. Current assets categorize all of the above. All assets which are expected to be converted into cash within the next year are labeled current assets. These assets are usually rather liquid. Working capital refers to current assets over current liabilities. This measures whether a company has enough short-term assets to cover its short-term debts. Accounts payable is an example of a short-term debt. It's owed by the company. Current liabilities refers to short-term debts or obligations. The firm should be able to cover these with the cash on hand and the current assets, referred to as working capital. Long-term liabilities are the liabilities that will be due after 1 year. These can be covered by future earnings, since there's plenty of time to prepare to pay them. Book value, or stockholders' equity, is a corporation's net worth measured by all assets minus liabilities. Retained earnings are earnings held by the firm to reinvest in operations or to pay debts. These funds have been withheld instead of paid out as dividends to investors. Days of sales outstanding. Average number of days it takes a firm to collect the revenue it gets after completing a sale. And days of inventory outstanding are the average number of days it takes to convert inventory in the warehouse into a sale. The income statement measures a company's financial performance for a period of time. It shows how the business incurs its revenues and expenses through both operating and non-operating activities. COGS refers to the cost of goods sold. It measures costs directly related to the sale of a company's product or products. SG&A refers to selling, general, and administrative expenses. These are the costs to the firm of operation. They are less direct than the cost of goods sold, for instance, payroll costs, research and development, and marketing costs. EBITDA is the net income with interest, taxes, depreciation, and amortization added back. It is an important financial reference because it removes differences in financing and accounting decisions that firms make, so you can compare firms across different industries. And EBIT is similar to EBITDA. It is important for comparing firms without the effects of different financial setups. The cash flow statement shows cash inflows and outflows for a period of time. Operating cash flows, the first category on that statement, is cash generated by normal business conditions. It helps to show a clear picture of how profitable a firm is in cash production of its operations. The second category is investing cash flows related to the purchase or sale of long-term assets usually. For instance, cash flows related to the firm's building and equipment. The third category on the cash flow statement are the financing cash flows. These are the cash flows between firm, owners, and creditors. It tracks funds related to providing finances for the firm's operations. Futures are contracts for the future delivery of a security or commodity at a set price and at a specified time. Options are the right to buy or sell a fixed amount of stock at a specific price within a particular amount of time. Within options, you have the right to call or the right to buy an asset or stock at a given price within a window of time. Or on the other side, you have a put, which is the right to sell an asset or stock at a given price within a window of time. An index is a collection of stocks, usually used to mimic an entire market or market segment. For example, the S&P 500 is used to track the U.S. market through its 500 largest public firms. An index fund is a mutual fund designed to track or match a market index, whereas a mutual fund is a pool of money actively managed by a portfolio manager. It is classified typically by the type of stocks held within the fund. And finally is the hedge fund. They professionally manage pools of money, like a mutual fund, but are subject to fewer regulations. They are less regulated because they cater to allegedly more sophisticated investors, which means that basically these investors have more money to invest. By no means is this list of definitions comprehensive. I've included free resources in the appendix for further definitions and explanations of common financial terms.